This is Monday, April the 13th, if I'm not mistaken. That's right. And this is the SPX Outlook for the week, expiration week for the April contract. Before I start, I need to tell you that one Opportunity Explorer is not functioning properly this morning, European time, so I am not sure I will be able to record the next video for members of the class. So let's have a look at this chart. This is a 4-hour chart on the SPX 500 USD, which is the CFD equivalent to SPX, and this one trades 24/7, which makes the charts a little bit more significant because there are more bars each day. So this is the 4-hour chart, and what we are seeing is that last week I said, well, this is that bullish congestion, or it indeed broke the 2650, which was the previous resistance. I was not that bold to say that it would go to the next major level, 2800, but in fact it did, and it was probably a more likely scenario after the former resistance test for support. This is quite a typical test for market participants. Some background information. I do not use moving averages. The only moving average that I use indirectly is because I use the Bollinger Bands, because of course the indices are generally mean reverting, and as you can see, when the market goes nearly to USD, it tends to also return to the mean. At this point we are nowhere near extremes, but of course volatility being high, moves can be quite significant. The 1SD projection of a 1 day today will be about 40 points. So a move of nearly 2% is quote unquote normal. So I don't use moving averages. They are lagged, and they also capture information, which is basically noise. If you were to use those kinds of trend following indicators, or even oscillators, I would advise you to change from a time bar chart to volume or tick or any form of other non-linear x-axis. It is not easy because generally you don't get a lot of flexibility on that front, but it does work for short-term day traders. I will come back to technical analysis at some point. It's a bit off topic. So what I use mostly is non-linear indicators like support resistances, and there are fibs, and this is the 61.8%, so the last barrier for bears to come back into the market and send it downward again. This was the 50%, and those levels are generally quite valid. And I mix them with my Merry math lines, which are also very interesting. And when they coincide, the convergence makes those levels harder to penetrate and break. So at this point, we have 2810 on one front, which is the MM lines, and we've got about 2790. 20 points is nothing considering the current volatility. So, and yes, the market tested 2010. Okay, it makes my point. It was really spot on, but it's not always spot on, especially when volatility is so high. But yes, this is a strong resistance area, same as this level. Now we have actually a strong recovery level all the way to 3125, which will be very difficult to break, and incidentally it was levels early March. So let's go back to this. There's a chance that we will get to a slightly bearish congestion. The VIX futures will expire tomorrow, and of course the April cycle will be on Thursday night, settlement on Friday morning. This is for I wouldn't risk projecting an outlook for more than 2 days, so this one is probably valid for up to Tuesday night, maybe Wednesday morning. So we may have a little wave here, and where could it turn into? This is also on a shorter time frame a former resistance that could be tested for support, so we may have the market bouncing again. I do hope otherwise that the market will rather go back to maybe 2700. Okay, last week I didn't want to say it could actually reach to 800, and it did. So, well, maybe it will actually fall to 26.50. I doubt it. So this is the 4-hour chart. As you can see, a strong support on 2500. You see, well, maybe this one, technically the pivot is here, 2500. And I would say that maybe this is not the right time frame to look at, but the pivot could be 2650 and the market hovering in the upper range, which is 2650 to 2800 or 2810. The quantum is still about 40 points. It's just multiplied because of the volatility. So the quantum is now maybe 80 or 160 points. The overall analysis of the dynamics is the same. So let's now have a look for a shorter outlook. Here we see the 2790, 2010 more clearly, and we also see the fib and EMM here on the 2650. And yeah, I mean, we should look at somewhere an average between those two lines for the top of the range and those two lines for the bottom of the range for a possible mid-range pivot, which could be around 2720, maybe 2730. It probably is a little bit lower than this line on 2733, but we will see. The market is retracing a bit this morning after the long weekend. I would say that we have a overall range here, 2650, 2800, and maybe a narrow range here, so we could have some salient levels at quantums of 40 or 80. So we will see how it goes. I would like to see the market passing the 2730 to go back to this range, which is 2760 to 2730. We will see. That would be a good indication that the market is now really topping. I mean, the peak is around here. The tug of war would be more or less balanced in this area. There has been a crazy recovery from 2200 a couple of weeks back. So this has been a very difficult reversal, especially for those who Vega hedged their position, now are suffering from lower volatility. This is a difficult market for market neutral options traders. There's not much more to say about this market. I would say that it will be bullish to bearish congestion, and it will probably hover. I would say there's a pretty strong convergence of levels here, 2690, 2710, but I would like to see further 2730 being penetrated to then give the sellers a little bit more courage to take the market a little bit lower. Okay, that's it for now. Unfortunately, unless one kicks back, it will be difficult to provide a weekly recap for members of the class. Thanks for watching, and bye for now.